Good afternoon, everyone. Morning for some, evening for others all over the world. Welcome to today's live trade session. I figured we needed to warm things up here a bit, so I pulled this out of the old repertoire. This is Clearwater Beach, taken probably 4 or 5 years ago now, and no photoshopping. I don't have time to organize my photos, much less change them through Photoshop. I don't even know how. I don't even own Photoshop. So that's how it was. It was absolutely unbelievable being there. It was bizarre. So warming things up here, and we're gonna go ahead and get started. We have a lot to cover as usual. I'm gonna remind everybody. I know I keep reminding everybody of this, but I want to keep it in front of you. We're waiting on one last thing, and once that one last thing is done, we can push this out for everybody. We are going to be able to publicly offer the purchase of stock in Trade Partner, and anybody can buy it. $100, $500, $1,000, $100,000. You'll be able to buy stock in Trade Partner. It's not liquid, but it is something that is no longer just available for accredited investors. It's some changes in SEC laws over the recent years that allow companies, small companies like myself, to be able to do this. I think it's tremendous opportunity for individuals to actually be a part of what they use every day in their trading. So that is coming. We're just waiting on one last thing. All right. For those that are new on the call, welcome to the call. If you're not familiar with what Trade Partner is, you'll see it in action a couple of times today. But I do want to welcome you and warn you that I don't explain everything about these trades on the call, nor can I. These calls are meant to be cumulative, and you need to attend. My recommendation is minimum 3 months. And if you're not really getting a grasp by the end of 3 months, I don't know what to tell you, but it does take some time. I'm not saying you're going to be proficient in 3 months, but 3 months and you'll start to really get a good feel for what we're doing. It is not that difficult. It just takes exposure. That's all it is. And once you start realizing what we're doing, you're going to realize these trades are fantastic. However, they are fantastic. They are not the holy grail. They are not absolute guaranteed trades. So you have to start small. You want to make sure that you're not reckless with how you put the trades on. You want to make sure that you accept whatever risks that are associated with whatever trade that you put on, and you need to follow the instructions. So just make sure that you use caution. You don't need to start big. Some traders start big and they end up going back and dropping back down to a one lot as they begin this process, because if you're too aggressive with it, then you might, as far as placing on these trades before you really understand what's going on, you might make mistakes. You might not account for something that you needed to account for, and it ends up netting you a loss when you didn't want to lose, or when you shouldn't have lost. So you need to make sure that you start slow when you do start, and you don't need to start big because the compounding is where the wealth is built. If you can average $100 a week, and most of you are not going to start by averaging $100 a week, but it's something that you can get to. And if you can average $100 a week and compound that for 6 months, you're talking about growing your account by as much as $30,000. So it is a significant growth. If you can't average $100 a week and you only average $20 a week, you can still beat the performance of Netflix over the last 7 years, which was the best performing stock. At least I think it was when I started these. I haven't double checked to see if it has maintained that status yet, but nonetheless, $20 a week over the next 5 to 7 years, and you will beat what Netflix has done over the last 5 to 7 years. That's how powerful the compounding is. And if you can get to the point where you are averaging $100 a week for an extended period of time, 5 years, you're talking about growing your account to 3 million. You're not going to do that with any other approach. It's compounding. You have to focus on the compounding. And when you focus on the compounding, that dictates the types of strategies that you also focus on. And so in this call, in these calls, we focus on SPY spreads. And TPO is called triple play options for a reason. It's to take advantage of spreads based on low volatility, medium volatility, and high volatility. And so as volatility changes, we'll change up what we're doing a bit. And one of the strategies that have just been tremendous over the past several months because of the low volatility is a strategy called option insanity. It's specifically tailored towards low volatility. And the issue with option insanity is because of how it's structured, it takes a lot of margin. And depending on the type of trade, it doesn't necessarily have a lot of risk, but then there are some trades that if you're willing to take the risk, they can produce a substantial return over time. This is one of them. This is the most risky option insanity version trade that I have. And it's a 5-to-1, and it's where we're selling 5 and buying 1. And the 5 that we're selling actually expire after the one that we're buying. And that's what creates this bubble here, as you can see. And what we do is we take advantage of the faster time decay on the 5. Then on the 1, especially in this bubble area, the profit bubble, where it really begins to pick up steam. So there's several ways to do this, several variations of this. This is one that I have on right now. I actually have on 2 right now, and I have on actually I just closed out a mistake I still don't. I'm still trying to figure out where in the world I made that mistake, but I'll get to that here in a second. Nonetheless, this is one that has a $350 credit, which means that if stocks tank, I'm going to make $350 no matter what. All right. If stocks begin to move up, then as they were and had been, now they're back down. I think it's back down to like three. I think we're trading around 390. This particular trade begins to balloon as far as the profit potential. This is about a $750 profit potential on this trade at the peak. I won't hold on for $750. However, I will look to hedge. Now, I will say that this requires a margin hedge. If you are short 5, long 1, you're naked, short naked 4, right? However, brokers don't count the long here because it expires before the short. So in their eyes, you're actually naked short 5 calls. So what you have to do outside of this is you have to go and you buy a March 1st really cheap call option, actually 5 of them, to offset these short 5. So you may spend, depending on how far out of the money you go, you may spend anywhere from 2 cents to 4 or 5 cents. Really depends on how much capital or how much margin you're willing to accept. So, for example, this one was, I believe, this is 398. I believe I had 420s. I had March 1st 420 calls. Let me double check that, and I'll tell you exactly where they are from. Yes, 420 calls, and I actually paid 4 cents for them. And I was willing to pay 4 cents because I had a 350 credit. So I actually have on the total, it's actually a 330 credit based on the 5 margin hedge, 5 contracts of the margin hedge that I have on, right? So when I've got a bigger credit, I'm willing to do that. And what that does is that eliminates the margin. And this trade actually costs about 10 grand to put on. But it is nonetheless a decent credit, a very high probability of success because you often have many opportunities to exit this at a profit. Um, as of right now, it's sitting at a $200 profit. 2 days ago, when the market was trading at 394, I think we were losing like $70 or 393, 394, somewhere around there. We were losing like $70, but this is the week that it ultimately would gain in value. The biggest gain in value would be this week. And so we've begun to see that with the market moving down a bit. And as of right now, that looks pretty good. So if you've been following, I've placed these on week after week after week after week, and have not taken a loss on these calls with this trade yet. I don't want to say that I won't or that I can't, because that's absolutely not true. Obviously, the market could skyrocket, but the further out of the money you go, the higher the probability. You're going to bring in a smaller credit when you go further out of the money, but you're going to have a super high probability of being able to get out of that trade at a profit when you do that. So, $350. I've been in this trade about maybe not quite 2 weeks, right? And $350 on a $10,000 margin requirement. That's not bad for a couple of weeks, especially considering the probability of success on this. But I normally do these because of the cross compounding. And these are the ones you cannot compound efficiently. I cross compound them. And what that means is that so let's say I make $350 on this particular trade. Well, that $350 actually goes towards my account balance, where I'm compounding my more aggressive trades that are able to be compounded more efficiently, because they don't require near as much margin, right? So this isn't great for compounding, but it can be cross compounded. It can contribute to the efficiency of the compounding that you're doing in other trades. All right. I know some of you are trading these and you're having extremely good success with those. Others can't afford to take this type of risk if the market were to absolutely skyrocket. Completely understandable. So we began looking at much lower risk trades. They still require quite a bit of margin, because the same thing is going on, in that we have two shorts that expire after the two longs, and so they are by brokers considered to be naked short positions. And so you do have to cover those with a margin hedge. And the great thing about what I'm going to show you with these trades is that you can place them on like 2 or 3 days before they expire. So you can, you don't have to go quite as far out to create the margin hedge, because we're not putting them on with 3 and 4 weeks left to go. We're putting them on with 2 and 3 days left to go. And so this particular one is one that I introduced a couple of weeks ago. We ended up getting out of this one at I believe this particular trade, the market was trading right at around 386, and I believe, if my memory serves me correctly, is we took a $14 loss on this particular trade, and that's about the worst of this. I mean, it obviously can get a little bit worse, but if you follow the criteria for putting these on, the risks can be just super, super low. So you can manipulate these a little bit, and this is a structure. This is a very specific pattern, and as long as you can get the price on the pattern and you're not going deep in the money, in other words, where this profit peaks are way to the left of the graph, as long as you're not doing that, you're going to be fine. And there's several different variations of that. So here's a trade that I placed on yesterday, and I mentioned this Tuesday, that you can start looking for these option insanity trades on Wednesday and even going into Thursday. And so this is one that was filled yesterday at 3:07 p.m. And I told you I was going to start looking for these. And I went pretty big on this one, as big as I could, because of the margin. And we've got nothing going on Monday, right? So this one expires tomorrow. We'll get out of it tomorrow, and on Monday, there is nothing going on to hold the value of the 222 options in place. And those are the ones that I'm short, right? So I'm short the 222 expiration options. And where this thing makes money is by a significant drop in the value of the Monday options on Friday. And that's what creates this particular pattern. And so you may not be able to accept the risk on something like the 5-to-1 option insanity. That doesn't mean you can't place a trade. If you have a $10,000, you can place this easily. You can place it with $5,000 in your account, but you just can't have very many other trades on. So you do have to have enough to make whatever other trades you're placing on plus the option insanity. But this is like a no-brainer. I mean, this is for the money that's not being used, is basically what this is for. Now, this is, again, this looks like it might be a holy grail type situation. And it's about as close as you're ever going to see. The only issue is that there is the unknown. It's not absolute certain that the volatility will come out of the long options the way that it normally does or is projected to do. But the great thing about this is that even if they hold the value in, okay, this is traded at a buck 38 credit. And at a buck 38 credit, that means if the market tanks, then you're going to make about $138, right? That's really when the danger of the volatility staying in the options occurs, is when the market drops significantly. Well, if it drops significantly, these are going to be way out of the money and they're not going to hold that much value. And so even if this is wrong, it can't be wrong by any significant amount that would cause you to not take the trade, right? There's no huge surprise here that is really realistically possible in the current situation. If we move up, it's actually going to drop the volatility more as a general rule. And if we move down, because we don't have to move down very far, it's not going to increase the volatility enough to really change this very much at all. And so this is a tremendous, tremendous, tremendous trade to place. Obviously, you can't place it now. We're at a buck 38, but we'll take a look at these structures here in a second. The only other thing is that the profit potential to the upside, probably not quite the way this is showing. This is really not a trade that we're placing on to make money if the market moves up. It's more of a neutral and even a bearish trade because of the big credit that is involved. If the market moves up to like 395, this is showing about a $25 profit. We might come out with about a $15, $20 profit, somewhere around there. But I'm not into it for the profit to the upside. Max profit to the upside is $38, right? So this risk here, this is the only realistic risk, and it occurs right at 393. And the probability is that you won't see it happen. So on this one, a couple of weeks ago, the worst price was a buck 36. The worst price was a buck 36 on that trade. And so on the day of expiration, so out of all the different strikes, if you would have gotten the absolute worst one, it would have been a buck 36, and we're in this trade from a buck 38. So that should tell you just how incredible this trade is. Again, the problem is that it does require about $5,000 to get into it. So, but it's a 2 or 3 day trade. I mean, so if you can make, if you can pull out $75 out of this thing, on a $5,000 account, that's a 1.5%, 1.5%. On 3 or 4 days, that's pretty good. That actually is an annualized return of about 150%. All in and of it by itself. I mean, literally, if you were to do nothing else but put on one of these trades every week, you could probably blow the market away. I mean, absolutely obliterate the broad market return with just this strategy. Another problem with this is that it's not always available. So when volatility starts to increase, we won't be able to get these prices. And so that's our cue that, okay, we're done. We got to move on. All right, so I'm not going to go over any other option insanity trades. There are other patterns, the W pattern, the big bubble like this one. This is the big bubble pattern. Great trades, but we've got so many others that we need to talk about. So let's see here. This is one that was from last week. Let me, whoops, here we go. This is the starting one. This is one that I got into, what was the fill date on this? I don't have the fill date on this. Nonetheless, I got into this one, I believe it was about a week and a half ago, and got in at a credit of 50 cents. And on these, this is a crazy calendar, and it's one of the more aggressive crazy calendars, meaning I'm going for a credit, and the way that I'm putting on this crazy calendar is I'm being less bullish with how I structure it, and I'm being more bearish, neutral to slightly bullish with this. Got in at a credit of 50 cents. You can see here that as of today, it actually expires tomorrow. As of today, right now, it has $30, about a $33 open position profit. Not the greatest in the world, considering where we're at. There's a lot of value that's still on these 390s. So I'm short of 390, long a 395. And oh, I've got that completely botched. Hang on a second. Well, I need to give you a right quote. I thought that was a little suspicious there, so I typed something in wrong. Hang on one second. We'll just so short the 390 and long the 395, right? That's the credit. And then the 393s are the calendars. Okay. So we've got a credit, and then we've got 393s. That's what creates this. And I'm going to bring this over real quick. That's more like it. That is at a 50-cent profit. Okay, that's where that's at right now. We're trading at 390.76, so we're actually above this first short, and we're headed towards the 393s. The question is, do I hold on to this? Thursday is generally the day that we deal with exits, and the temptation is to hold on to this trade. And if you're going to hold on to the trade, here's the risk. There are a couple of economic announcements tomorrow, and we see the market bust to, let's say, 395, go right past the 393s, and go to 395. Well, this is an aggressive variation of the crazy calendars. Very aggressive in that once it gets past the calendars, then the profit projection just tanks. I mean, it drops fast. So the whole purpose of this was to create, sorry about that. The whole purpose of this was to create a bigger credit and be more bearish neutral. And so with that being said, and with where we're at in the market, this is where I hightail it out. There is no way, and this is similar to what I did last week. There was one that we were in, and it could have gone up and could have made a little bit more money if it had gone up into the profit zone, but we already had a decent profit. We're not trying to make a killing with these trades. We're just trying to make a little small amount every week on a high probability basis. And one of the reasons, one of the ways to create a really high probability scenario is to make sure that you exit properly. based on the ability to exit at a profit and analyze the probabilities of what happens if you hold on. Okay. Now, if the market drops, I'm going to make $50. All right. So right now I'm making about $50 on this trade because it's at a credit of $50. So no matter what happens, if the market moves down, I'm going to make $50. But it's this risk now. We're one day out. A one-day move to the upside could wipe that out and produce a significant loss in comparison to a $50 trade. But we got into this when the market was way down here, right? So so the probabilities were high, but now that the market has moved into this profit zone and actually is threatening the potential of going right past the profit peak of the calendars, no reason to hold on. Get out. Just like last week, there's no reason to hold on. We're not playing this to get a couple of extra bucks if the market moves up and then risk turning this into a loss. All right, you take the profit when it's available and when the probabilities are such that if you hang on, the damage, there's an equal probability of damage happening, right? So we're trading almost at 392 right now, or 391 right now. 4-point move to the upside, not that big of a deal. That's 395. That would put us in loss territory. That would not be a big deal. If we move down 4 points, right? So that'd be a 4-point move to the upside. If we move down 4 points, what do I gain? Zippo. I'm going to make 50 bucks. That's it. So at this point, in time, at this juncture, the probabilities are now no longer in my favor because I've got the profit. And an equal move of $4 will actually produce the win-loss ratio if it's 50-50 every time. So if I were to place on this trade right now at a 0 credit, and 50 times it moves up $4 and 50 times it moves down $4, I'm going to lose significant amount of money. Right? So the EMR at this point, I call it the equal movement ratio, and I haven't talked about that a whole lot in these calls. I reference it every now and again, but the equal movement ratio is not in our favor. And so it's a no-brainer. You exit, get out, and that's it, period, end of story. Okay, I hope I'm really clear on that because some people get these, some traders get these dollar signs in their eyes, and they're like, "Oh, we're fixing to go up into the profit zone. I can't wait. We're gonna get a big one." I mean, you remember when we back in October, we're taking $600 profits on these things. Well, that's not available anymore, right? And I've only got 3 calendars on this thing because I've specifically structured it to be more bearish neutral to slightly bullish, and that's what's happened. And so you take it out. Okay. I hope everyone is clear on this. Okay. All right. Good. Moving on. Here is a trade filled from last Monday, not Monday as in obviously the markets were closed Monday of this week, but the previous Monday. So we've been in this one for not quite 2 weeks. Got in at a credit of 26. And this is, again, a crazy calendar. It's exactly what you see here. It's a credit, right? It's a credit with the calendars at 395. So it's basically this exact trade, only everything is moved up 2 points. Everything is moved up 2 points. And on this one, I got in at a credit of 26. And with the market trading where it's trading at right now, it is trading at a $79 gain. So again, this one ends tomorrow, and we have less risk in this particular scenario. We have less risk for the market to move into the risk zone because the risk zone starts at around 396. All right, so at around 396, that's where the market begins to drop off as opposed to 394, right? So you can go to this one, you can see 394 is where that begins to drop off. This one is the same thing, only at 396. So what do? We're sitting on a $79 profit, and there's the potential for the market to do what? Potential for the market to move up and the potential for the market to move down. Well, what happens if it moves down? The $79 could turn into only 26. All right, so I actually stand to lose money if the market moves down. So that's one, or lose money from where it's at right now. Let me put it that way. What happens if the market moves up? Well, I actually stand to make a little bit of money if the market moves up, maybe another $75, right? So now I've got a situation where the equal movement ratio within a 4-point range is slightly positive. It's not tremendous, but it is slightly positive. What's the probability of the market moving up to 396 tomorrow and not allowing me to take a decent profit before it does? Not that great. Pretty high probability that if I hold on to this trade and the market moves up, that I'm going to actually take a little bit bigger profit than I've got right now. But what if the market moves down? Right. So what am I in this for? Am I in this to maximize my gain, or am I in this to maximize my probability of achieving a consistent profit as often as I can, a small profit consistently as often as I can? That's what it is, right? So guess what I did? I exited this trade. Exited at 54, as a matter of fact, 54. So at an $80 profit is what I exited this trade for. It doesn't matter what happens now tomorrow. Okay, I took an $80 profit. It was a very high probability trade, and that's the end of the story. I achieved my goal, and because of that, I'm not sitting here trying to eke out this bigger profit in a situation where, again, I specifically put this on to be more geared for bearish to bearish neutral to slightly bullish. All right, because you'll notice that the three calendars, right? What I used to pay for the three calendars was, again, a credit spread. It wasn't a diagonal spread; it was a credit spread, and that allowed me to get a bigger credit on the trade. But it also increases the risk if the market were to move up, or excuse me, move up, right? As opposed to a diagonal, if I would have put the long at long 222 as opposed to a 219, then I'd have a smaller credit, but then my risk would not, it wouldn't look like this. It would be more protracted, and it would be smaller as the market moved up. It would take longer to realize a bigger loss. So I specifically put this together to focus on a more bearish neutral scenario. $79, $80 profit, can't complain, move on, be done. Are y'all getting the gist of it and how this is done? If I had more calendars, right? Because in previous weeks, there are trades where we've put 4 calendars on, sometimes 5 calendars on, and that increases the bubble significantly. And if that were the case, I might consider hanging on to this a little more, depending on what the profit on the trade was. Okay. All right. Moving on to the next one that we are in, but this one doesn't expire until next week. And this is one that we put on last Thursday. And this was based on the risk-free calendars. So this is the third strategy that we have trades on. And by the way, actually, before I get to that one, let me see if I kept this one on here. Oh, I didn't. So you'll recall that I was in, oh, here it is. You'll recall that I was in 383, 387, and then 386 calendars. And I got into these way back on 129. They were a 3-week trade, basically, and the market had to move up. The market was trading in the lower 70s, 370s. Well, I had one that expired last week, and I took a loss on that one, right? And these aren't official trades that I took in the calls. These are trades that I took in one of the accounts where I'm a little bit more aggressive in how I put some of these on for a reason. Um, but with this one, the market just shot up and moved right past this profit zone, the risk zone. And I ended up taking a significant loss, $400 on the one that expired last week. And I was in danger of taking a similar loss on this one this week. Only this morning, when the market came down, guess what? It allowed me to get out. And I got out at a $50 loss. And that was it. Again, looking at the EMR ratio, and the probability of what could happen if the market were to drop into the further drop into the profit zone versus if it would have stayed the same or moved up. And that one I did take a loss of $50 on. I took it early this morning and ended that one, and then I replaced it. All right, so when I say you have to be willing to take the loss on this one, very rarely will I actually take a loss on a trade early. Um, and the reason that I did it on this one is because we had already moved so far past the risk zone that a drop back down into or approaching, it didn't quite make it into the profit zone, but approaching the profit zone um, creates an opportunity and to not take the maximum loss, which was if the market had stayed the same, if the market had stayed up at around 393-ish, we would have taken almost the exact same loss last week or this week as we did last week in this particular account. Again, neither of those were official trades because they were too aggressive for what we do. I tell people you want to go as far out of the money as you possibly can and while creating the desired credit. And you want to make sure that you don't do it um, when the market is trading lower. Okay, you can do it, but the risk is when the market's trading lower, you have a much higher probability to see a bounce. That's why you did not see these trades when the market was in 370s. This is why we did not take these trades when the market was down in the 370s. Nonetheless, let's move on to the risk-free calendar core trade. So the risk-free calendars, of course, is the strategy where we're taking a look at the potential of putting on calendar spreads with no risk on them, which means that you sell the nearby expiration, let's say for $1, then you also buy the further expiration for $1. And of course, you can't do that at the same time, right? You have to leg in and then you have to be patient. And the highest probability of doing that is to go out of the money, sell a leg, and then be patient and let time or market action bring the long leg down to the price that you sold the short leg, and then repeat the process as often as the market allows. The problem is that does require you initially selling a short leg and being naked a short leg, and you risk the possibility of the market immediately moving higher after you sell the short leg, never getting in your long leg, and now you're sitting there with a short and possibly a lot of risk. Well, one way to achieve the same goal is to create a core trade, and the core trade has the purpose of creating risk-free calendars in the middle of the core trade. And so this is the core trade. And we placed this on, I was filled at $1. And basically what this means is that if I'm filled at $1 credit and I do nothing else and the market tanks, I'm going to make at least $100. And if the market closes around 396, I can make, that's probably not going to be $200. It's probably going to be closer to $150. If I were to hold on to the last second, which I would not do, rarely do we hold any of these trades until the last day, if we can avoid it. It's the option insanity trades that we want to hold till the last day. for the most part. These trades we do not want to hold for the last day for the same reason that we're placing on option insanity trades. And so with this one, if I did nothing else, I've got a long profit zone that is above $100. Obviously, it can tank. It can go to zero. I'm going to make $100. I want to make at least about $100, all the way up to about 400. And so this one expires next week. And the probability of going past 400 next week is not very high. And so this is a pretty decent trade in and of itself with nothing else going on. However, the purpose of this trade is not to put this on and keep it. It's to create risk-free calendars. So I sell one, sell two, and buy three. Sell one, sell two, buy three. That's the pattern. You can do other patterns. I mentioned those on Tuesday. I'd go and watch the recording of Tuesdays to deal with that for a second. So, and I need to uh, speed things up here just a bit. Man, time is just flying. Nonetheless, the purpose of this was to create risk-free calendars. So what this is doing is it's creating a scenario where I have a credit to play with. I sold two of the 400s, right? Two of the 400s at $1 a piece for a total credit to $2. But the sell price for each was $1 a piece. Okay. What that means is that I can now turn around and place an order to buy the March 1st. And I don't know why this shows February 25th, February 28th. The expiration dates are February 26th and March 1st. So hopefully that doesn't cause any confusion. Nonetheless, the March 1st 400 call, I would then place an order to buy one at $1. Right. And when that is filled, then I look to place another short 400 call at $1, and then place another long 400 call at $1, and then et cetera, as many times as the market allows, or until I want to just stop. And there's several reasons why you might want to just stop. One of them being the probability of maybe getting filled on another short is probably small, right? And that's kind of what I did on Tuesday. And I told you guys I was done with this. I did not put on an additional long leg. I kept the short legs. So essentially, I added two February 26th 400 calls at an average of $1.33 a piece, and I added long two March 1st 400 calls at an average of $1.17 a piece. So I actually created a debit in this particular example, or excuse me, a credit in this particular example with calendar spreads. And the reason that this happened is because one morning when I had, which was Tuesday morning, when I had a 400 call, short 400 call order in place, the market gapped up, and I got filled at $1.44 on that call, and I think I had I think I had it placed at like 120 or something like that. So when that call sold, I chose not to add another long and just keep the whole credit. And this is what was created. And I mentioned on Tuesday that at that point, you can get rid of the risk on this trade by getting rid of a piece of the trade. Okay. Now, if you want to take a look at the trade, the entire trade was placed on it like a 200, I had like a $230 credit based on the calendars that I had. And with this particular trade, the risk to the downside, obviously, there is none, right? I'm going to make the credit. The profit peak is at 400, and then there's risk. There's risk to the downside on this thing. Well, what happens if I were to get rid of a piece of this core trade now that I've created some risk-free calendars? What happens if I get rid of a piece of this core trade? And the piece that I actually did get rid of, and I mentioned this on Thursday or Tuesday, is the 396 and the 401. That's where the risk is, right? is one 396 and one 401, not all three of them, just one. So I get rid of the real risk is this 396. And again, I don't think there's a lot of risk for the market to move up past 400, but I'm in a lot of trades. And so if I have the opportunity to create an absolute risk-free scenario, why not do it? And that would allow me to open up some risk capital to put on some new trades, right? So you begin to profit stack. In other words, you have the ability to profit stack. And so with the risk being really this 396, what I chose to do is get out of the 396 and one of the 401s. And I did that at a profit, and actually got filled at a 62-cent debit on that particular trade. Okay, a 62-cent debit. Which means if I got in at a dollar credit, I made like $38 on the core trade. All right, so I make $38 on the core trade. Now this creates a scenario. I took out the risk of this particular trade by getting rid of just a piece of it, and this is what it looks like. And you'll notice that for the most part, my credit remained almost the same. And my profit potential in the middle actually moves up because this 396 is not dragging it down. This short 396 would not be dragging this down at the 400 level. So I actually open up the profit peak even more. And then there's zero risk to the downside, period. And how do I know that there's zero risk to the downside? Because I have a credit on this trade that exceeds the strike difference. And the credit on the trade is like 200 and actually, I don't think it's 230. I think it's like 210 or 211, somewhere around there. And the strike difference on this trade is at 2 points, right? So what is the strike difference on this trade? You have 400s here. There's no strike difference, right? So there's 3 where there's no strike difference, and then there's 2 where there's 400 and 2 with a 401. That makes the total strike difference $2. I have a credit of like 210, 211, 212, something like that, which means that it is impossible for this to become a loss, no matter what, to the upside, period, end of story. I have no risk on this trade. That's a risk-free calendar trade. And placed on where you take the profit off of some of the profit off of the core trade. Okay, so that's the process. Yeah, this was not one where I was able to put on a lot of risk-free calendars, and it's one where I specifically chose not to attempt to put on any more risk-free calendars because I wanted to stick with the credit. Right, so once I put this on, I specifically decided not to add another long and keep the process going, and instead look to exit the core trade. And the reason is because it becomes harder and harder to sell that 400 for $1 the closer we get to expiration, especially when it's out of the money like that, which it was, of course, and still is significantly out of the money. And so once that happens, I'm like, time to stop. And if I'm given an opportunity to get out of the core trade at profit, I'll do that, get rid of the risk, and then start the process all over, maybe with the following week. And so I don't have to wait for this now to close out in order to start another series of trades. And in fact, I can use this now as a buffer because if the market goes up to 400 next week, I'm going to have a significant gain on this trade. And I don't have to worry about whether I'm going to get out early or not get out early. I can make the call based on where the market is at. And if the market is trading here around 390, 391, I know that there's no reason to get out of the trade because I want to make that amount of money if the market moves down, no matter what. But if the market moves up, I have nothing but upside. Right. So that would be a no-brainer that you hold on until the last day and maybe the market moves up and you take a bigger profit. However, if the day before we're trading at the 400 level, and I've got a pretty sizable profit here, if the market were to continue moving up, then I might give back some of that profit. And if the market moved down, I might give back some of that profit. And so at that point, I would probably exit early and be done with it. So again, we'll take a look at this next Thursday. We'll see where we're at, and then obviously we'll go through the exit, the process and the thought process as far as exiting this as well. All right. So because of this, now I'm left with, okay, what do I get into now? Well, the market's trading about 390, almost 391 right now. So we can take a look at those. And so I'll do a spread position here. Let's see, reset. All right, so I'm going to bring this over. This is Trade Partner, and we are going to do a spread pattern, and we're going to do the core trade on the since I exited the core trade, I also exited pretty much all of my crazy calendars, so I can put on another crazy calendar right now as well. But I want to look at the core trade first, and the core trade is. Hang on one second. So the core trade, you'll notice, is a 396 and a long that is 5 points above it, right? So it's the short, and then a long is 5 points above it, and then the calendars, or I should say, here, let me get back to the original core trade. It's only 3 legs. So 396, then the 401, and then the calendar is 1 strike below that. That's where we're going to start placing the calendars. All right, so that's the pattern that I'm going to put together here, and we'll see where they're priced. And we're going to go with not next week, but the following week. So we'll go 3538. Now, I will warn you that 3538, the first week of March, is generally bullish. And so it would not surprise me to see the market make an approach to the 400 level next week. I don't think it'll go past it, but I think it very well could make an approach. So we'll just start with 389, and then the 394, and then the 393. All right, so I probably should have put that in different order, but that's all right. So this is the first sell is 1. The buys are going to be 3, and then the second sell, which is a higher strike, is going to be at 2. All right, so it's a 1, 2, 3. And this particular one, 389, 394, 393, that's at a 279 credit. That's a huge credit. But look at the call. The price of the call is at 393. This is how you know you can't put this on and use the same process. All right, so this is a core trade, trading at 279. The purpose of this trade is to then, after I'm filled on this trade, to buy a 3.8 393 call at the price that I sold the 3.5 393 call at, and that would be 356. So if I have a 279 credit on the trade and my purchase is going to be 356, what does that leave me with? It leaves me with a debit. So I automatically know that I'm not going to do this. Besides that, you always need to go out of the money with these. So that just kind of goes through the whole. Actually, I probably should have gone past 400, but that's all right. We'll just we'll do this one. All right, so I'm going to generate the spread, and it's going to populate all the spread prices here. It's going to take a second to go out and grab all those. But we're going to go out of the money, and we're going to go and look for the one that has about $1 credit. And that's pretty standard with what I do on those. If I can bring in $1 credit, then I know I'm probably going to be paying around $1 for the long, or selling the calendar call, if you will, for around $1, maybe slightly less. And in this case, it is slightly less. So this is a 397 short, long 402s, and then short 2 401s. The 401s are going for 88 cents. The whole thing is going for a credit of 106. So what do? I place this trade on, and then I place on the order to then purchase the 38401 call. All right, so we're going to put this in a smart share file, and I'm actually going to do it in a different window. So smart orders, hang on one second. And I will bring this down. So this is going to be my risk-free calendar for 3-5. All right, I'm bringing this down right here. So I just named it. That's my risk-free calendar 3-5 file. Okay. So I'm going to come down here. I'm going to get rid of this. Collapse the chart. We'll go 20 strikes. That be enough? Should be. Nope, not going to be enough. So we'll 40 strikes. All right, and I'm going to do 3-5 and 3-8. All right. So the first thing to do is to put on the core trade, which is the 397 short. All right, so 397 short, and then the 401. Oh, it went back up. 3-5. Then the 401 short. Sorry. And then the long will be for actually 402. All right. So scrolling all the way back up. All right, so we've got 397 short. We've got a 401 short, and the long is at 402. So we're going to go 1, 2 shorts, 1 short, 2 shorts, and then 3 longs. Whoops. And you can see here it's at $1.04, $1.05. So the first thing I'm going to do is, let's see here, place this order 1. Maybe. The Zoom screen is messing it up. There we go. At a credit of $1, it's going for $1.05. I'm going to put it in at $1.05. Okay, and I'm going to do it as a day order. So if I'm not filled on the core trade today, I don't want to, I'm going to take another look at it tomorrow, is basically how that works. Okay, so then what I'm going to do is I'm going to add a 38401 call. And let's see here. 38401 call. Oh, it did it to me again. They have got to fix that. That is annoying as all get out. I collapsed the option chains, and they decollapse on me when they update prices. So buy a 401. All right, so everybody see this. Let me do this real quick. All right, so 401 is where we're going to focus on putting the risk-free calendars. Okay, so I'm going to add a group, and I'm going to say if order 1 is filled, then execute order 2 and I'm going to do it at a limit of 93 because that's where the short is trading. Now this is trading at a buck 16, so guess what? I have to be patient and let this one play out. And the zoom screen is messing with my ability to toggle on these. All right, there we go. All right, so when that happens, I have this as a GTC order because if I'm filled on my core trade, then I want this order to be in place even tomorrow, right? All right, so this is now trading at like we're moving up, so I'm going to move this up. I'm going to move it up to 108, and I'll keep that at 93. All right, so that's it. That's the first set of this particular trade. And then I just simply turn it on and away we go. All right, so that's the trade, and it is exactly what you see right here. Only the longs or the short is not at 396, it's actually at 397. And so it's actually just kind of like one strike higher than what we see here. Okay. And immediately, as soon as I buy the extra long, however long it takes me to buy the extra long, then I create a much, much lower risk situation on this trade. And I have a very high probability of getting filled on that extra long. Okay. All right. Now, I've spent the last couple of weeks on risk-free calendars and the core trade of risk-free calendars. We've gone through the process of creating a significant risk-free scenario, and we're going through that process again. And so we will spend a little more time on the risk-free calendars as opposed to the, or excuse me, on the crazy calendars as opposed to the risk-free calendars in the next session. All right, let's see what questions I've got. When I compute the OI trades in the portfolio, these seems to be too much risk. I know this cause volatility variables are too high. Can you show how to properly adjust volatility in PDS portfolio to estimate the trade correctly? So, so last week, let me pull this up. Where is it? I'm gonna bring PDS Trader here into view as soon as I can find. Oh, I know where it's at. Searching through my 6 windows here and approximately, actually 6 screens and approximately 100 windows open. Yeah, I know, it's nuts. Okay, so here is the exact trade that I have on in Option Insanity. And so if I were to, so the volatility may look something like this. All right, and that's what this might look like when you first bring it up. However, that is completely unrealistic because the volatility numbers that we get from, by the way, that will change when we have a completely different volatility approach than what the data provider provides. I've complained about this from the beginning, but nonetheless, the at-the-money calls, the Monday at-the-money calls, are averaging at about $1.25 on Friday afternoon. So what I do is I go to 391, right? So I go to 391, and this says that tomorrow at the close, my 391 call, if the market is trading at 391, is going to be losing $40. Which means that it's going to be priced at $1.85, $1.84. Okay. The price of the at-the-money longs has been $1.25, not $1.84. So what I do is I change volatility to reflect what the prices have been over the last several weeks, and we've got nothing going on Monday, so it should be fairly accurate. So now this one is showing at 391 that the 391 call is going to be worth maybe a buck, buck 15, buck 10. And that actually is probably pretty accurate because last week when it was at a buck 25, there was an extra day, right? Markets were closed on Monday, so technically there was an extra day. They were closed in the U.S. They were not closed elsewhere, so that does influence that. So I expect that we'll see at least a buck 25 or less, and so this is going to be much more, much closer to being accurate, and that's how you do it. Is it possible to use existing option insanity searches in PDS Trader? Yes, absolutely. I do it all the time. The problem is that they're going to show these elevated volatility numbers. And so you have to know exactly what you're looking for. Let's see, 26th March. Yep, that one answered that question. Where will the recording of the presentation be posted? It's posted in PDS Trader. So log into PDS Trader. If you're not familiar, if you have not logged into PDS Trader, contact support. They'll help you out with that. On the risk-free TP trade, why didn't you use the reference price feature for the order 2? Oh, I didn't want to confuse everyone. The reference price. So the reference price is a really cool feature in Trade Partner to where, and this is, it does end up confusing some people. So let me hang on one second. I'll bring this down and just show everybody. I know it's going to be really close based on where it's at. So I wasn't really worried about it. So hang on. I'm reopening that window. All right. So you can see that I have now been filled on the core trade. All right, filled on the core trade. The question is, why didn't I use the reference price? So here I did a limit order, and I was basically saying, okay, I'm probably going to be filled at like 93 cents on the short. And so that's where I'm going to place the long. I could have been exact, and I could have done what's called a reference price. It's a really cool feature. No other platform has it. And basically, I'm going to say place order 2 at order 1, leg 2, fill price. And so I was filled at 96, and so it will then place order 1 at 96 cents. So that's how that works. I didn't do it again because it's not really necessary when I kind of know where it's going to be filled at in this situation. But great question, Mike. You absolutely can use it if you want. I just didn't want to get into the weeds with that. Welcome to the power of Trade Partner. Are you planning on reducing these procedures to writing so that we have something to refer to without having to spend hours and hours sorting through videos? Yes. So when I get hours and hours of time to reduce these to writing, believe me, it is something I've wanted to do. It takes a lot of time. I did not understand why order number 2 is GTC. So here's what happens. Order number 1, if that's not filled, I have no reason to place order number 2, right? So if order number 1 is not filled, then order number 2 is never ever going to be placed. If order number 1 is filled, then I definitely want order number 2 placed, and I want it to remain placed. And so I will leave it there. And the only way to, so I could do it at a day order, but then if at the end of the day, if that's not filled, guess what? I have to come and put the order in tomorrow. And that for me is just more work and more room for forgetting and making a mistake. So I put that one at a GTC. Once it's at a GTC, if I want to change it, if I think the market's going to open down and I can get a way better fill, then I'll change it and do that. But in case I don't, or in case whatever, I've got other stuff going on, I've at least got it working the way it should be working. Again, the power of trade partner, so I don't have to think about it anymore. Which reminds me, so last week I put on another option insanity trade for March 5th, I believe. Put on an option insanity. I sold 402s for like I sold five 402s for like $1.30. Placed the long order because it doesn't allow me to do it as a spread anymore. Placed the long order. The long order wasn't filled, and then I forgot about it. And so today, I actually exited the entire thing for about a $300 profit, having never placed the long order because I just simply forgot about it. And so I then went and placed the right order. So I know, long story to answer your question, but I did want to mention that it does happen. Let's see. When LOL, I can imagine how much time, but you're young, LOL. Why, thank you, Jerry. I appreciate that. All right. Is there anything that y'all would want me to focus on more in the next call? Let me ask that. And I want to make sure, obviously, that I'm covering everything in a manner that, I mean, we're looking at 3 strategies, and that's always difficult to cover in an hour. But it offers, a lot of different opportunities. Basically what I'm showing is that there's more than one way to skin a cat, and averaging $20 a week, that should be your first initial goal. Not a problem. Should not be a problem. All right. So, all right. Let's see here. What happens if my 401 is not filled? Well, I accept the risk of the core trade. That's what happens if my 401 is not filled. I have a very high probability of that 401 call being filled because it's way out of the money, 10 points out of the money at this point. And even on expiration day, that 401 call could be filled. Obviously, I wouldn't do it at that point, but that being the case. All right, let's see here. All right, perfect. How many days out are the optimal times to place each kind of trade? So for example, the option insanity trade, it's really based on price. And that's one of the things that I've tried to get y'all into the habit of with the spread pattern functionality in Trade Partner. You can do right. So we bring this here. Here's the 3.9. This is 353835, right? It's now trading at a credit of $1.13. Market is moving up. Like, how many times have we seen it move up on a Thursday afternoon during the call? Granted, it's been in a bullish mode, but it's been quite common. All right, so what you can do is you can go and you can compare prices. All right, so let's bring this back a week and go 226, 31, and 226, and look at the same exact spread, the 397, starting with the 397 short. Okay. Let's see here, 397 short. Wait for it to populate. So anyone that has normal, like regular internet speed, do you have any problems pulling up the prices on these? I have slow internet, so I don't know if it's the internet or if there's something that we need to do to speed this process up a bit. I think that's my internet, so I'll do it again. All right. So while we wait for that, So basically, what I'm. So let me tell you what I think's going to pop up here. We're going to see a lower price on this 397, 401, 402 spread. Okay. Why isn't that coming up? That's annoying. It's because we're live. That's why it is. I just. um, so I'm going to say, if I can't put this on for $1, right, then obviously then it kind of dictates that I can't do 226.31 and go that far out of the money, right? The following week, if I do 3538, then I can go here and I'm probably going to do $1.50. So I could actually go further out in out of the money if I want to go out for another week. So it's really dependent on the pricing of the spreads, is what I'm saying. And I have no clue why this did not update all of a sudden. I hope you guys can hear me okay, and my internet didn't completely go out. Perfect. So I will spend more time on the next call discussing timing for each. And it's really dictated by the market pricing. All right, I'm writing it down. Let's see. Would you ever offer a type of managed account where our accounts are connected to yours and their trades are taken on ours? No, Derek. I don't do that. If you're interested in a fund-like setting, you can email me, but I don't manage accounts. Lately, it's been moving up at around 12:30. Yep. What time will I exit the 111 tomorrow? At the open? No. I will wait on this 111. So the question was, like on this one, when will I exit? This is my option insanity trade. When will I exit this? Tomorrow? I'll either exit it at a profit target, probably sitting at around $75, or depending on where the market is at. So if the market is at 393, which is the risk point, then I'm probably going to go for a big, slightly, smaller profit target, and then just end it there. I have fast speeds. Prices sometimes take a minute. Yeah, well, this one hasn't done it at all. I don't know if it's so that very well may be my internet. Okay, so it is slow. I'm gonna talk to the programmers about that. All righty. So I think I've got a little bit of direction of where to spend a little bit more time focusing for Monday's call. Hopefully y'all enjoyed this one, and I will see you on Monday.